A pandemic hit the whole world in 2020, and the UK and US economies have been pretty much on the decline ever since. Yet when we take a look at the stock market, especially over in the US, we see it booming like it's 1999. And over the course of 2020 and 2021, we've seen the stock market have its biggest ever detachment from the economy. Now, when I say stock market, I am talking about the US stock market rather than our UK stock market. And the reason is because of the same thing I say every time on this channel. The US economy is huge compared to our UK economy, and it presents a huge opportunity for investors. I mean, Apple, just a single US company, has a larger market cap than the entire FTSE 100, which is the largest 100 companies in the UK. And so we can't just restrict ourselves to the UK stock market, we have to look beyond. So today we're going to share our views on whether the stock market is overvalued, and we'll be looking at two tools that can help us determine whether the stock market is overvalued to try to gauge what will happen. Will it crash or will it keep booming? Hey, what's up people? Welcome back to our channel, Ralph Finance UK. So let us get straight into it. When you look at the US stock markets, it's pretty clear that they are near their all-time highs. I mean, the S&P 500 and the Dow Jones have both increased by around 70% off their bottom in March 2020, and the Nasdaq has nearly doubled off its bottom also in March 2020. Now in the UK, the FTSE 100 has recovered from its bottom in March 2020, but it's still over 12% lower than what it was before the crash. Whereas over in the US, their stock market just keeps rallying. So the US stock markets are booming as if the economy is thriving, yet if we look at what happened to the US economy over the course of 2020 and going into 2021, we see they have had so many businesses shutting down and people losing their jobs. I mean, from March 2020 to April 2020, the unemployment rate spiked by more than 10%. That put 16 million Americans out of a job within a single month. Now the good news is that the 14.7% unemployment rate did decline over the last few months, but what is concerning now is that rate is actually leveling off around the 6.7% mark. Yes, this is a lot better than what it was before, but it is still nearly double to what it was before the pandemic, and it isn't dropping any further, which suggests that the US economy is far from recovered. Yet the stock market just keeps going from strength to strength. And even here in the UK, we have seen a record number of redundancies, hitting 370,000 just in 2020. And now the government are predicting that unemployment could reach 7.5% by mid-2021. That's more than 2.5 million working age Britons out of a job. And the Bank of England says that it could even be as high as 10%. Bearing in mind, before this pandemic, the UK unemployment rate was just 3.8%, so it is a huge spike. Now, one of the main reasons the US stock market is booming so much is due to the intervention of the Federal Reserve, which is their central bank, like the equivalent of the Bank of England here in the UK. Now, the economy runs on people spending money, and so because the United States economy is in a recession, the Federal Reserve have lowered the interest rates as a way to make money cheaper to borrow, which then encourages people to spend more. So firstly, in 2019, interest rates were cut as a way for the Federal Reserve to stimulate the economy. And then in 2020 came the pandemic, and the Federal Reserve cut interest rates yet again, this time to all-time lows, near 0%. So previously, if the interest rates were already high, then it simply just wouldn't be worth borrowing to invest in the stock market. And so essentially this limited how expensive the stock market could get. Now though, with the interest rates so low, it is quite the opposite, and this cheap debt makes it very easy and cheap for people to borrow money and invest it straight into the stock market. On top of this, the Federal Reserve have implemented an unlimited quantitative easing policy, which essentially means an unlimited printing of money. In 2020, the Federal Reserve printed more money than ever before. More than $3 trillion were printed just in 2020. That for us is £2.2 trillion, and a lot of this money went straight into the stock markets to artificially inflate the stock prices, and the Federal Reserve are doing whatever they can to prevent a crash, and all this is doing is pushing them prices up further and further away from the true value, and it keeps the stock market inflated. And this then has a knock-on effect, because when people see that the Federal Reserve is back in the stock market, they want to ride the wave as well. They get confident and they think, well, the stock market cannot fall. Much in the same way people thought real estate couldn't fall in 2008. So now, as the Federal Reserve are back in the stock market and not letting it crash, when the government hand out these stimulus packages to regular people, a lot of this money is ending up in the stock market as retail investors get greedy and try to make some quick cash, which further inflates the prices. Now, we've also got to take a look at bond returns because previously, if the stock market looked expensive, then investors would traditionally be investing their money in bonds for a few percent return. But now, with bonds paying almost 0% and many bonds even yielding negative returns, investing into bonds anymore just isn't attractive. And so all of that money that would have been in bonds is now in the stock market. And nowadays, we also have a lot of emotional trading going on in the markets. I mean, if we take a look at Hertz, the US car rental company, they saw a 570% rise in share price after they filed for bankruptcy, as retail investors got greedy and saw the share prices being cheap. And this led the stock to being worth double what it was before they went bankrupt. Then we see when the pandemic first hit, Zoom, the video conferencing company, they became very popular as people were staying indoors and video chatting. This was a good investment opportunity. However, retail investors started up buying shares of the stock with ticker symbol ZOOM, thinking this was Zoom, but what they were actually buying was a completely unrelated penny stock. The penny stock then rallied 600% within a single month, and the SEC, the US Securities and Exchange Commission, they had to intervene. And lastly, a vaguely worded tweet from billionaire Elon Musk encouraged his users to use Signal. Now, while he meant the encrypted messaging app Signal, investors misinterpreted the tweet to mean Signal Advance, a medical device firm completely unrelated. This then caused Signal Advance's shares to go from around 37 pence a share to nearly £30 in a matter of a few days. And then when investors realised, they quickly sold off, causing the share price to drop by nearly 80%. But even now, the stock is at just over £10, which is significantly higher than what it was before. This is all a consequence of emotional trading, and what we're seeing now is a big distortion between a company's stock price and how much money it's making, especially in the short term until things rationalize. Now, one of the actual reasons why we have so much emotional trading going on nowadays is because there is such an easy access to investing. Everyone has an easy access. Before the 1980s, only the wealthy, educated and sophisticated would know how to invest, as you had to know a stockbroker and you'd actually have to read pages and pages of stock prospectuses. It was nowhere near as accessible as it is today. Nowadays though, with so many new online stock brokerages and commission-free stock brokerages and ETFs which span the globe, stock market investing has never ever been more accessible. And with this easy access to investing, there are consequences, the main one being that it brings in a lot of people that may not know what they're doing and they end up emotionally trading. Some economists do believe that this easy access to the stock market is bad because it's setting the retail investors up for a massive crash that the pros, the institutional investors, they'll be able to handle, but the retail investors won't. Also nowadays, we have quite a big concern, and that is there was a lot of money printing in 2020. Now this is more of a problem over in the US with the dollar than it is here in the UK, but as you'll have heard me say in previous videos, whatever happens to the US dollar does affect our British pound. The US dollar is the world reserve currency, and it has been since 1944, and 70% of all currency reserves in the world are in the US dollar. Now the colossal money printing in the US has led to 20% of all US dollars in circulation to being printed just in 2020, and the US dollar has consequently lost 95% of its value since 1940. And so cash seems to be the least safe investment, and with these fears of high levels of inflation, investors are now looking at other ways to hold wealth rather than cash. And one of these is the stock market, and that is causing it to boom even further. I mean, if investors believe cash will continue to depreciate, then they will choose to invest in the stock market even though it is expensive, rather than holding cash. I just want to say, if you are finding value out of this video, then please do hit that thumbs up button. That way you get more of my videos recommended to you. So now we have the retail investors who are driven by emotion. They are given a very easy access to investing. They see interest rates are nearly 0%, which means they can borrow money for basically free. And on top of all this, they know that the Federal Reserve is back in the stock market. And all of this is the perfect recipe for a stock market boom. Now, institutional investors are also concerned with holding cash as there are fears of high levels of inflation, which is another reason for the stock market boom and perhaps why we have also seen the surge in gold and Bitcoin recently. So, is the stock market overvalued? Well, apart from viewing all the information we're given, we can also do our own analysis by looking at something called the Wilshire 5000 to GDP ratio. This is also being called the Buffett Indicator, as Warren Buffett describes this as probably the best single measure of where valuations stand at any given moment. So the Buffett Indicator takes the Wilshire 5000 index, which is the total US market index, and it basically compares this to the US GDP. So it's essentially a way of showing how fast the stock market is growing relative to the US economy. Another way to think of it is how much people are willing to pay for the stock market per pound of GDP. So this chart shows the Buffett Indicator. Now we can see there was a steep climb leading up to the dot-com bubble in 2000, where the Buffett Indicator had reached its then all-time high of 1.4 before dropping. And then again, just before the real estate crash in 2008, we saw it climb to 1.05 again before crashing down. Now in 2021, it is currently sitting at 2.01, which is the all-time high. So it means that the price of the US stock market is about twice the US GDP. So this would suggest investors are pretty optimistic. I mean, based on the Buffett Indicator, we are seeing the highest valued stock market in history relative to the size of the US economy. And this just shows how detached the stock market is getting from the true economic reality. This is bigger than the dot-com bubble and bigger than the real estate bubble. Now another tool we can look at is the Shiller PE ratio. So the PE ratio is the price per earnings ratio. It's a way to value a company and it can show whether a company is overvalued or undervalued. Now the PE ratio is essentially how much an investor is willing to pay for £1 of profits. It can also be viewed as a measure of the number of years an investor is willing to wait to earn back the purchase price if the company had zero growth. So looking at the Shiller PE ratio chart, we see that historically investors were willing to pay a share price that's roughly 16 times the earnings or profits. So if a company earned £1, then historically investors were willing to pay about £16 to own those companies. We saw the spike in the 1930s where the PE ratio hit an all-time high of 30, and then another spike in the dot-com bubble in 2008 where the ratio hit nearly 45. And currently, despite what's happening in the economy, investors are currently willing to pay about 34 times the earnings. So that would suggest again, investors are very optimistic about the stock market. So is the stock market overvalued? Well, according to the Buffett Indicator and the Shiller PE ratio, then yes, it definitely indeed does look expensive. However, the real question is, what is the alternative? If there is no alternative, then we will probably continue to see it boom. Overall, we can see that the US economy is in a recession, and now the Federal Reserve and the government are trying their best to pull out of the recession, and they're going to continue printing money. But the key difference is, you can pump trillions into the stock market to artificially inflate it, but you can't artificially inflate the economy. And now with investors, institutional and retail, continue to buy stock based on the backing of the Federal Reserve, it seems the stock market will continue to boom. Now, what the government and the Federal Reserve are essentially banking on is that as the stock market keeps going up, the economy will start to recover and then thrive quickly and essentially catch up to the stock market. Overall, the stock market is very emotional in the short term and driven largely by fear and greed, but it does rationalize over the long term. Eventually, the stock market and the economy will have to come to an equilibrium. Either the stock market has to crash to meet the economy, or the economy has to grow to meet the stock market, or it could be a combination of the two. This could take a week, a month, a year, or many years. If it works out great, then we could see an economic boom. Unemployment will drop and the economy will thrive to meet the stock market and we'll have that equilibrium. Or if it gets worse and people still don't have jobs and income streams, then we will have an issue because eventually the stock market's going to have to correct itself and come into equilibrium with the economy. Overall, nobody knows what will happen and when it will happen because there is just too much uncertainty. I mean, if we look to the US, they're already seeing an increasing number of COVID cases, even when we take into account the increase in the number of tests. Then we have uncertainties surrounding when we can get a vaccine into mass circulation. And if we look to Europe and here in the UK, the new lockdowns have already been imposed. And this affects the US as well, as the US do business with Europe and the UK. What we could see is people eventually panic sell due to fears of uncertainty, and this could cause a mass sell-off. And all of these factors play a hand in whether we see a correction or a full-out crash. But overall, there is really no way of knowing when the stock market will correct itself, especially with it largely driven by the Federal Reserve and by retail investors who are emotionally trading with fear and greed. So, I hope you found value out of this video. If you did, then hit the like button so you get more of my videos recommended to you, and subscribe so you don't miss the next one. I hope to see you on the next one. Take care.